Hello and welcome to another edition of Market Briefing. I'm Martin Bakkerdax, European business editor here at the IB Times UK. Fascinating day across equity markets. We're holding at multiple year highs, 5-year highs in fact, for the FTSE 100, but investors are taking their foot off the gas just a little bit. There was some economic data here in the United Kingdom which was a bit disappointing. I'll get to that in a second. But by and large, investors are still playing the same bet. Central bank support is going to lift equity prices and continue to do so for the next few months. We're only 9 points from an all-time high for the S&P 500, and we've printed multiple times the all-time high for the Dow Jones Industrial Average. Now, parallel to that, which I find fascinating, is that a measure of equity volatility, it's known as the VIX, and many people call it the fear index, is also trading at a 5-year low. So investors are not only liking the bullish tone to the marketplace, they don't seem to be terribly nervous about it pulling back anytime soon as well. Bill Gross, of course, who manages the world's biggest bond fund, talked about this last week when he said that the lag time between deciding to get into the market and making that long position for the biggest investors can take 3 to 6 months. So he felt that that gave the bullish run even more tenure. So that's very interesting to see, and you can see it playing out, at least for the moment, amongst North American equity markets. But as I say, here in Europe, we're pulling back just a little bit. Now, part of that reason is the grisly figures we saw for manufacturing and industrial output in January here in the United Kingdom. The ONS gave us the data today. The manufacturing output dropped 1.5% from December. Industrial output, a little bit of a wider measurement, fell 1.2%. Next to that, there were some better figures with respect to Britain's trade deficit, and that unexpectedly narrowed in the month of January. But ultimately, these figures do suggest that Britain is going to have to work really, really hard in the services sector in order to avoid that triple-dip recession. Now, that figure won't be known to George Osborne when he delivers a budget on the 20th of March, but you can bet that that tone is going to color any decision that he's ready to make. Two stock stories we're looking at in the UK today include HP. They said yesterday in an SEC filing that the Serious Fraud Office here in the United Kingdom was opening up an investigation into autonomy. Of course, in 2011, HP bought autonomy for about $10.3 billion US. They had to write $8.8 billion of it off because they said autonomy managers basically overstated the value of the UK software company. Mike Lynch, the former autonomy CEO, has denied these charges vehemently, but nonetheless, this allegation and many allegations like it are working its way through the judicial system in the United States, and it seems the Serious Fraud Office here in the United Kingdom is also involved. Lloyds Banking Group also in the news today. The state-controlled lender, 39% owned by us, the taxpayer, shifted about a 20% stake in St. James's Place. That's a wealth management group that it bought from HBOS in 2008. They netted about $400 million. They're going to use that money to increase the capital buffers of the bank. Shares are trading around 50 pence, but a long way from that 73.6 pence mark, which represents break-even the UK taxpayers. Check out that story and a whole lot more on the IB Times Economy page. We'll see you tomorrow.